Hello friends. So friends, let us continue with non-profit organization that we were discussing about, right? Now in the last lecture we discussed about the first type of books, that is receipts and payments account. Receipt and payment account, right? I told you that for the non-profit organization, they have to prepare three sets of books. The first is the receipts and payment account. The second is income and expenditure account. And the third is the balance sheet, right? So what we discussed the receipts and payment account in the last lecture. Now in the receipts and payment account, I told you that you have to record all transactions, right? All transactions, that is every kind of a money that is coming into your pocket, right? You have to record that. And every kind of a transaction that involves the money going out of your pocket, you have to involve that, right? So all the transactions are to be recorded in the receipts and payment account, and we discussed the format also, right? And it is similar to a cash book. Clear? Now, one important thing here that I missed in the last lecture, that you do not record non-cash transactions. So I told you whatever is actually coming into your pocket or going out of your pocket, you have to record only that portion. Now what is a non-cash transaction? Can you give an example of this non-cash transaction? So yes, the non-cash transaction can be depreciation. Now if we talk about depreciation, you all know this. In case of depreciation, only the value of an asset comes down. There is no actual cash inflow or outflow, right? So depreciation is my non-cash transaction, right? What else can be the non-cash transaction? Outstanding expenses, right? It is also a non-cash transaction because there is no actual inflow or outflow of cash in this transaction. So what you have to record in the receipt and payment account is all those transactions which involve the actual inflow and the actual outflow of cash, right, from your pocket. This pocket will consist of, right, this pocket. Now this is your pocket. This pocket will consist of two parts. This part is cash in hand, cash in hand, and this part will involve cash at bank, right? So your pocket is divided into two parts, cash in hand, cash at bank. You have to take both into consideration while preparing receipts and payment account. What you have to not consider is the non-cash transaction. So be careful about this thing, right? When we talk about the receipts and payment account, the rest of the things we have discussed in the last lecture about the receipts and payment account, right? So now in this lecture we are moving on to the second type of the books that are to be maintained by the non-profit organization, that is income and expenditure account. Income and expenditure account. Now let's discuss about the features of this. Now when we discussed about the receipts and payment account, I told you that it is a copy of cash account. Now what about the income and expenditure account? This income and expenditure account is similar to profit and loss account, right? So you all know how to prepare the profit and loss account. You record incomes on one side, you record expenditure on one side. Similarly, in case of the non-profit organization, we call this profit and loss account an income and expenditure account. Now tell me, sir, why it is not called profit and loss account? Because in case of a non-profit organization, the motive is not to earn the profit. So we do not use this profit word, right? That's why this profit and loss account in case of non-profit organization is known as income and expenditure account. Clear? Now, if you talk about profit and loss account, how you prepare this profit and loss account? Here you record all the incomes, right? Here you record all the expenses, and whatever the excess of income over expenses is known as profit. But when we talk about income and expenditure account in case of NPO, here you will record all the incomes, right? Here you will record all the expenses. Now, excess of income over expenses will not be called profit. This will be called surplus. And here you record loss. In case of NPO, this loss will be known as deficit, right? So be careful about these terminologies when you are preparing this income and expenditure account. It is a copy of profit and loss account. It has to be prepared as we prepare the profit and loss account, right? So here we call it as income and expenditure account. So this was the first thing, right? Now, second thing. In case of receipt and payment, I told you that you have to record all the capital as well as revenue receipts and payments. This is what we discussed, that we have to cover all the receipts and payments, whether they are of the capital nature or they are of the revenue nature. But in case of income and expenditure, they say capital income and expenses are not to be considered, right? That is, only revenue items will be considered. Only revenue items will be considered, right? So in the receipts and payments account, we said we have to record everything whatever is coming into your pocket, whether it is of capital nature or whether it is of revenue nature. But when we talk about income and expenditure account, we say we have to record only the revenue items and not the capital items. Why? Because if you remember, in the profit and loss account also, you do not consider the capital incomes or the expenses, sale of fixed asset. You do not consider it in profit and loss account. Clear? Now let's take a small example regarding this. There is a furniture, say, right, whose book value is rupees 1000, right? Now it is sold for, say, 1500, right? Now how will you prepare this? What is the profit in this transaction? 1500 minus 1000. 500 is the profit in this transaction. Where you will record this profit? If you go to the profit and loss account, where you record the profit, this profit will be recorded in income and expenditure account. But this sale of 1500, it will be reflected in balance sheet and not the profit and loss account. Clear? So be careful with this thing. That's why I'm saying the capital, income and expenses are not to be considered here, right? Now the third thing. Third thing is, it says non-cash transactions are to be considered. Right? Just now I told you that in case of receipts and payment account, do not record the non-cash transactions. But when I talk of income and expenditure account, because it is a profit and loss account, then you have to record the non-cash transactions also. For example, if you talk of depreciation on an asset, where you show this depreciation, do not you take it to the profit and loss account? Yes, sir, we take it to the profit and loss account. If you take the depreciation to the profit and loss account, then I told you that income and expenditure account is nothing but a copy of profit and loss account. So that's why you will take this depreciation to income and expenditure account also. That means the non-cash transactions are to be considered. Clear? Right? Now, next point. The fourth point, it says transactions relating to a particular period under consideration are to be recorded. Now, if you remember, when we discussed the receipts and payment account, there I told you that record all the transactions, whether they belong to the current period or whether they belong to the previous period or they belong to the future period. This is what we discussed. Now, in this income and expenditure account, it says that you have to take the transactions of the current period only, that is for the period under consideration. Right? If the period under consideration is 1 year, which is normally 1 year only, right? So you have to take the transactions relating to the current year only. This means current year income and expenses only. So if any amount is received relating to previous year, then that amount will not be an income of current year. That amount will not be an income of current year. That will be considered as income in the previous year only. Clear? Okay, I'll explain you with an example. Suppose you are preparing the income and expenditure account of 1/4/17 to 31st of March 18, right? You are preparing income and expenditure for that. During this period, you received a subscription of 10,000 from a particular member, that is A. Clear? Now, out of this 10,000, 5,000 is for 2016-17 and 5,000 is for 2017-18, right? Now, in this case, if we talk about the receipts and payment account, right? Here I will record subscription as 10,000. Why? Because receipt and payment account says that you have to record every money that is received in your pocket. What have you received in your pocket? 10,000. Whether it relates to the previous period or the current period doesn't matter. Whatever is coming into your pocket, you have to record that. Now, if we talk about the income and expenditure account, income and expenditure account says, in this case, if I talk about the subscriptions, it is my income. Now, I will record 10,000 or what? Income and expenditure account says you have to record the incomes of the current period only. Current period is 1718. So whatever is the income of 1718, you have to record that only. So subscriptions will be 5,000 in this case. Clear? So this is what it's saying, the transactions relating to a particular period under consideration. Period under consideration is what? 1/4/17 to 31st of March 2018. So whatever the income relates to this period, we have to record that in the income and expenditure account. If any income is relating to the previous year or to the future year, that will not be considered while preparing the income and expenditure account. Clear? This is very, very important to understand this point, that what you have to consider and what you don't have to consider. Clear? Clear, friends? So what you have to do, you have to record only the incomes pertaining to the current period that will be recorded in the income and expenditure account. Right? Current year income and expenses to be recorded. Now, another thing, here I told you that in case of excess of income over the expenses, we have to write it as surplus and not profit. Be careful about this thing, because in case of non-profit organizations, we do not have to use the word profit, because their main motive is never of earning the profits. Their main motive is the social cause for which they are working. Clear? So never use the word profit. This is very important, right? So I've told you it is a copy of profit and loss account. Capital income and expenses are not to be considered, only revenue items to be considered. Non-cash transactions are to be considered, for example, depreciation. Transactions relating to a particular period under consideration, that is the current year, is to be considered while preparing the income and expenditure account. Clear? So it is a copy of what? It is a copy of profit and loss account. The only thing is, we do not give it a name of profit and loss account. We have replaced it with the name of income and expenditure account. Clear? Now let's see how our income and expenditure account looks like. See, here it is a specimen of income and expenditure account. Right? On the credit side, you will record all the incomes like you do in the profit and loss account. Right? Then here you will write all the expenses like you do in the profit and loss account. Right? To salaries, add outstanding. Why this outstanding amount has been added? Because if it relates to, because this is the income of the current period. If the outstanding relates to, if this outstanding relates to current year, right? Rent for the current year, insurance less prepaid. Prepaid is what? Prepaid means for the future years you have paid in advance, right? This is for the future years. Clear? That's why it is to be subtracted, because we have to take the expenses and the income of the current period only. Clear, friends? Printing and stationery, expenses. Repairs of equipment, expenses. Depreciation, yes. Because why? Because I told you we have to consider the non-cash expenses and incomes also. Sundry expenses. Subscription, add outstanding less advance. We will discuss this in detail when I will do this adjustment on subscription. There I will explain you this, why it is added and why it is subtracted. Like, right? Donations, income. Entrance fees, income. Sale of old newspapers, income. Sundry receipts, income. Rent received, income. Right? If here I say by sale of fixed asset. Will it be valid? No, sir. This will not be valid. Why? Because any kind of capital expenditure or capital income we do not have to consider. We only have to take what? We only have to take revenue items, right? And whatever the excess of income over expenditure, it is shown as surplus, the balancing figure. And if the balancing figure appear on this side, what you will write? You will write as at by deficit, right? So it can be either surplus or deficit. So this is how you have to prepare income and expenditure account, right? Be very careful about the points that we have discussed here, that the non-cash transactions are to be considered, transactions related to current period only that are to be considered, capital income and expenses are not to be considered, right? So these are the few important points that you need to remember regarding the income and expenditure account. Clear? So this is how the income and expenditure account is prepared. Very simple. If you have done the profit and loss account very well in the +1, then this the preparation of income and expenditure account is not difficult for you people, right? So with this we have covered the second aspect, that is income and expenditure part. Now coming to the next aspect, the third part if we talk about, that is balance sheet. Now when we talk about the balance sheet, right, it is prepared in the same manner as any other balance sheet. It is prepared in same manner as any other balance sheet, right? So how you prepare the balance sheet? Any other balance sheet for the year ending, right? Now on this side you will show the assets, on this side you will show capital, right, plus other liabilities, right? Now this is understandable, assets and liabilities. Now what is the capital in case of NPO? What is the capital in case of NPO? The capital is the money that is being received from the members, that is subscriptions, plus if there is any entry fee, that is for becoming a member you have to pay the one-time fee. This is one-time membership fees, right? So this can be the entry fee also. This comprises the capital of the NPO plus. Now if you remember, in case of the balance sheet, whatever the profit that you get in the profit and loss account, where you transfer it? You transfer it to the capital in the balance sheet, isn't it? Now in case of income and expenditure, what do you get? You get surplus instead of profit. You will transfer this surplus to their capital. Surplus from income and expenditure account. So this constitutes the capital of the balance sheet of NPO, right? Rest of the balance sheet is prepared in the similar manner. Like here you have cash in hand, cash at bank, then you have assets less depreciation, right? So it has to be prepared in the same manner. If any prepaid expenses, if any outstanding liabilities, right? If you have any prepaid expenses, because that is your asset, because that's benefit you are going to enjoy over a long time. So rest of the balance sheet is prepared in the similar manner as we prepare the balance sheet of any other business, profit making business. Clear? So the NPO balance sheet is to be prepared in the similar manner. Now let's look at the specimen of the balance sheet. See, name of the institution or the club, right? Institution or club means NPO, non-profit organization. Balance sheet as at 31st March 2011 or whatever year. Now the capital funds I told you may consist of entrance fees also. It will be the subscriptions also. It may consist of subscriptions also. Entrance fee plus surplus this from income and expenditure account. Income and expenditure account. Right? If it is a deficit, it will be subtracted. So this constitutes my capital fund. Subscriptions received in advance. It is a liability because this is not for the current year. Right? Outstanding wages, price fund, building fund. Fund is what? You are setting aside some amount of surplus to make a fund. Right? Here you have got the fixed assets. Building, less depreciation. Furniture, less depreciation. Books, less depreciation. Any investments, outstanding subscriptions, prepaid insurance. Outstanding subscription is your asset because you have to receive that money, right? Cash at bank, cash in hand. So this is how you have to prepare the balance sheet of any NPO. The major aspect is similar to what we prepare the balance sheet for any profit making organization. The only thing that you need to understand is how to constitute a capital fund in case of NPO. This is to be done carefully, right? Why it is to be done carefully, we will discuss in the next lectures also when we will discuss the various adjustments related to this, right? We will discuss the various adjustments related to this. Clear? So this is how we are going to prepare the balance sheet. Clear? The major aspects are similar, right? So now we have discussed all the three books. We have discussed income and expenditure account, we have discussed receipts and payment account, and we have discussed the balance sheet also. The basics we have covered, right? Now we'll wrap this lecture here only. In the next lecture, what we are going to do is we are going to do some adjustments, right? Important terminologies, adjustments, and their treatment, right? This is going to be very, very important. This is to be done very carefully. We'll start with the first adjustment, that is subscriptions, right? So this is very important. The subscriptions part is very important, right? So in the next lecture, we will start with adjustments and their treatment, right? And friends, if you have any queries, you can send me an email at ksjteaching@gmail.com, right? So that's all for this lecture, friends. Thank you so much.